Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Traders trim bets on a December Fed cut after Jerome Powell says there's no hurry to lower rates. President-elect Donald Trump picks vaccine skeptic Robert F. Kennedy Jr. to lead the health department, but there's no room for Jamie Dimon, CEO of JPMorgan, at Treasury. Plus, Chancellor Rachel Reeves says the UK's crackdown on banks has gone too far and is hindering growth. This as fresh GDP data crosses the terminal right now. We'll bring you those numbers shortly.
In the meantime, a quick check on these markets here. You are seeing sentiment really sour. Red on the screen when it comes to Euro Stoxx 50 futures, down by 0.6%. The FTSE 100 down by 0.4% as well. Eurodollar also seeing multiple weakness, 105 handled there, but slight strength this morning, higher by 0.2%. And Brent crude right on the cusp of that 70 handle. We'll bring you all the updates. Countdown to the opening trade starts right now.
The picture is now clouded by the impact of geopolitical shocks and broader fragmentation in the world economy. Now, I have to own up to being an old-fashioned free trader at heart. I think it's a British characteristic. I like to think it is. My point is this: amidst the important need to be alert to the threats to economic security, let's please remember the importance of openness. It's an important determinant of productivity.
Andrew Bailey, the Governor of the Bank of England, speaking last night at the Mansion House over the road from here. The Chancellor, of course, joining him there, delivering a speech. Both of them talking about the idea that maybe relations with the EU need to be improved. The Chancellor talking about the idea as well that maybe we need to aggregate our pensions to boost the idea of higher growth here in the UK. We'll come on to talk about all of that a little bit later. We have evidence to back all of this up right now. There is something of a data dump in the UK this morning. It's led by the GDP data, which looks a little soft.
Yeah, the GDP data for the month of September, Guy, that's the only new bit of information on GDP. The quarterly number, of course, we knew two-thirds of it already, but this final piece, September, minus 0.1% on September GDP, and that was against an estimate of a growth number of 0.2%. So we do see the pound responding a little negatively to that, initially, at least erasing some of those gains, but now regaining some of that momentum it had earlier. I mean, we already knew that the economy was losing steam. It certainly did that in the first couple of months of this quarter. Since the start of the year, which was stronger, the summer was a little more sluggish. Bloomberg Economics, incidentally, going into this number, expects that the real wage growth to sort of kick in by the fourth quarter, and so things, in their view, could get more positive.
So maybe we end the year more strongly as the way we started it. We came into 2024 on quite a strong footing. That has then subsequently faded. It's interesting, actually, that total business investment was down, but a little better than anticipated. There was this kind of pre-budget lull when everybody got very concerned about what was happening around taxes, and that maybe crimped investment and spending, both of the consumer side as well. So there's a lot going on in all of this. We'll talk about the Mansion House speech a little bit later on in more detail.
Yeah, I'm excited because, and it's not usually my area of expertise, but they said a lot of stuff about regulation and regulatory authorities. So we're going to nerd out a little bit.
This is the new Spain, isn't it?
This is my new obsession for the week. We'll see what happens next week. It's very exciting.
OK, let's talk about Jay Powell last night. So here's the question.
Kriti's perennial obsession.
Correct.
Back to the Fed.
Back to the Fed. I'm not sure about that. Let's talk a little bit about Jay Powell. Why did they go 50 to start with?
Yeah.
When you back off in the way that you are now backing off? The data probably speaks to some reason for this, i.e. you've looked at the City Surprise Index, it's increased massively since we got that 50 basis point cut from the Fed. But Powell was sounding, I thought, really quite cautious last night in terms of the narrative that he has delivered. He's mirroring what we're seeing from others. But it does kind of open the door to December not being a cut.
Not quite as likely.
And then you talk about next year. Next year, I think the visibility on next year in terms of rate cuts has diminished dramatically. Yeah,
it does seem as if the market reacted as if this was, Kriti, a little bit more hawkish than had been anticipated, raising some questions about December, taking the probability of a cut in December from 80% to 60%.
445 on the 10-year, pricing that idea in. I feel like I'm curious how much of this, he won't say it on the record, but how much of this is a little bit of Trump-proofing when it comes to his thinking, maybe. And it feels like we're getting early signs of that caution.
Maybe. I think if you're going to throw politics into it, you bring in the 50 basis point cut going into the election, which I think a lot of people will talk about kind of historically, I think, and look at that and question that. The Trump presidency, at the moment, it's... we know who the people are. We just don't know what they're going to do. This is a cabinet that is being formed, to many people's surprise, in a way that you would have expected. And you're seeing the loyalists come in. I just don't know what the policy implications of that are. The market reacted quite strongly yesterday to RFK. The market reacted quite strongly yesterday to what was happening around this story around EV tariffs as well. There is clearly some caution now starting to be priced in after the Trump bump.
We talk a lot, you were going to say that Trump bump. We've seen a little bit of the Biden unwind as well in the chip sector and where that investment is pulling out from. I think the interesting bit is I'm obsessed with the EV story specifically because so much of the EV growth has been tied to that climate change agenda and the green transition agenda, but it's also been largely a subsidy story. And this idea of Elon Musk kind of coming in this advisory position of the Department of Government Efficiency and maybe cutting some of those subsidies, not even necessarily to himself, but to other parts of the American economy. Agriculture, of course, is one that comes to mind as well.
Yeah, one of our colleagues suggesting is this, to weaken rivals in the EV space. I mean, we'll see. To what extent this has Elon Musk's blessing as well is not necessarily clear at this point.
Well, I think it does, but I think it's interesting what he's saying. What he's saying is basically you should remove subsidies for all energy. Yeah. He's saying you should remove subsidies for hydrocarbons, which he thinks are heavily over-subsidised anyway. So in some ways, you could argue if you level the playing field, that would make gasoline prices more expensive and maybe make EVs more attractive.
So this is where I think big picture, you start to say, well, OK, the Trump trade might not be as simple as a Biden unwind. There are nuances to it, especially when it comes to the energy picture. And that's what it feels like traders are really navigating right now.
Yeah, and we certainly will keep in mind the moves we've seen, yes, in autos, but more perhaps specifically in some of those healthcare stocks, some of those pharma names that were down quite substantially in yesterday's session, the likes of Moderna, Pfizer and Novavax, just at the end of the session when we got confirmation of Robert F. Kennedy being Trump's pick. Obviously when he comes in, not yet. But these names still have to clear the Senate. We keep saying that. And then we see Trump putting increasing pressure on the Senate in that regard. And I wonder where that goes.
They have to clear the Senate, but he has a kind of loophole in that if the Senate isn't around, he can do these on recess appointments, which is basically the way you get business done, right, when, say, the Senate's on holiday, for example. So we'll see if that's a playbook he uses.
It's being talked about quite a lot. I'm certainly reading a great deal about it and the legality around all of it. Anyway, what have we got to discuss on the show? An awful lot this Friday. Christina Matti, head of European small and mid-cap equities, is going to be joining us from Mundi a little bit later on. Small caps have taken off in the States, not so much here in Europe. Chris Watling, CEO and Chief Market Strategist at Longview Economics, is going to be joining us as well. Get his take. He's positive on what the US delivers in terms of returns going forward. And Ros Altmann, former UK Pensions Minister, joining us to discuss what we got last night at Mansion House when it comes to the consolidation we are likely now to see in UK pension funds, certainly state public pension funds, local government public pension funds. We've got a busy day as well. I just had a data dump out of the UK.
Yeah. Well, we're going to get plenty more data points potentially throughout the rest of the day, specifically in the States. But before that, 10 a.m. UK time, we get this EU Commission publishing their economic forecast. Growth certainly in focus here in the UK. It will be in, of course, the rest of the EU as well. But what does that look like? What quantification can we put on there? We'll get those numbers out at 10 a.m. UK time. Then at 1:30 p.m., U.S. retail sales, Empire Manufacturing, the data coming out of New York as well. And then 2:15, industrial production, not to mention plenty of Fed speak. Do they echo the sentiment of Chair Powell from yesterday?
Let's talk about what else you need to know as well. This morning, France's Prime Minister says he may have to trigger a clause in the Constitution and bypass a vote in Parliament to get the current budget approved. Michel Barnier made the comments in a newspaper interview. Lawmakers have rejected the budget. They did so back on Tuesday, sending the debate on reducing France's ballooning deficit to the Senate. It'll then come back to the lower house. It'll go round and round until we get a confidence vote. The US Federal Trade Commission is reportedly set to investigate anti-competitive practices at Microsoft's cloud computing business. The Financial Times says the regulator is looking into allegations that Microsoft is blocking customers from moving data from its Azure cloud services to rival platforms. The report says tactics include exit fees and punitive licensing terms. And China's economy is showing some encouraging signs after retail sales grew at the strongest pace in 8 months. Factory output grew slightly less than forecast last month, destabilisation signalling that Beijing's recent stimulus efforts are starting to pay off. There's a few green shoots.
If you squint,
emerging.
you could see that message.
Maybe.
Yeah, certainly retail sales, they came in a little bit better than had been expected, and so that's maybe what people are looking at. But there are some voices of caution, aren't there, around this morning, and some big voices from, big amounts of money at their disposal. I'm thinking here of David Tepper, billionaire money manager, saying that the buy everything message that he put out in September around China, that is over for him. So that was sort of short-lived, wasn't it? But we're still waiting for some of the detail around some of this spending, some of these plans. And Michael Burry as well, hedge fund manager, adding downside protection on his China call and his Alibaba call. So that's something we'll watch.
Barbara's about to break, isn't it? We go to the top of the next hour.
I believe so. We're going to get those earnings, of course, on the major e-commerce front. And we should mention that you have to kind of compete with the Amazon success, because the last Amazon earnings came out incredibly stronger than anticipated. So we'll have to see if that shows up in BABA as well. When it comes to China, though, I think there's a little bit of a roadmap here. Is there a little bit of bottom feeding on these valuations? And can you apply that same logic to Europe, for example, if you see a further sell-off?
And are you just waiting for clarity on tariffs? And before you get any of that, you know, how difficult it is to make valuation decisions, I suppose. Coming up on the programme, JPMorgan's CEO, Jamie Dimon, says that bankers are, quote, dancing in the streets at the prospect of less regulation from Donald Trump's next administration. We will bring you more of Dimon's comments from the APEC CEO Summit that was taking place in Peru and continues to take place, and we'll bring you those later in the show. Plus, the European Commission is set to release new economic forecasts. We'll go live to Brussels to discuss what we expect from there. Up next, we'll be joined by Alex Yekov, who is G10 FX strategy head for Europe at BNP Paribas Markets 360. Lots to discuss about how the euro is going to respond into a second Trump presidency. If you have any questions for our guests, please, this Friday morning and every morning, get in touch with us. IB plus BBTV Go is the function that you can use on your Bloomberg terminal. This is Bloomberg.
The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve.
The Fed Chair, Jay Powell, I'm just kind of digesting what he just said in the light of that 50 basis point cut they started with. Not in a hurry now. The data kind of support maybe that narrative. Maybe the politics do as well. Let's talk about how markets have reacted. Bloomberg's Valerie Teitel standing by.
Guy, good morning. Fed Chair Powell was asked a lot about his assessment of what these Trump policies could mean for their outlook. I want to talk about some few things that I found interesting that he said. When he was asked about the fiscal spending and the possible tax legislation that might be pushed through, Guy, he said that the legislation could take over a year to pass and that the impacts on growth, they might have to wait till 2026 or 2027 to see the positive impacts on growth. He was also asked about tariffs, said that the impact of tariffs isn't obvious to them. He did note that it was the retaliation that they want to keep their eye on. But he was talking about tariffs under the guise of a downside hit to growth instead of being an inflation impulse. He was also asked on immigration. He said that the size of the labor market is very important when it comes to U.S. growth. A shrinking of the U.S. labor market could be a downside risk to growth. But how did this all shake out when it came to markets? Markets were squarely focused on his comment that they are in no hurry. We have completely reversed now the rally that we saw post-CPI over a three-day session. The two-year yield now basically trades flat as that December cut is now put into question. But what hasn't really been winging around too much is the dollar. The dollar is on a 5-day winning streak. I want to talk about the price action that we saw in the euro yesterday, Guy. We briefly tapped 105, and after that we saw the euro rally from there. Poses some questions that there might have been some profit taking on those euro-dollar shorts in yesterday's session. Maybe for now we've hit some peak pessimism in Europe when it comes to euro-dollar positioning.
Val, thank you very much indeed. Perfect way to start with our next guest, Alex Yekov, head of G10 FX strategy for Europe at BNP Paribas Markets 360, joining us around the table. Let's start off with the dollar. Good morning, by the way. Nice to see you. Dollar's been on a tear. How much further does it go?
We think it can go further. For us, it's all about Trump's policies at the moment, which are going to exacerbate, we think, the divergence between European and U.S. assets. FX is a relative asset class, so it should be the asset class to best reflect that. Now, I'm thinking specifically of euro-dollar, which is impacted through two channels, and Valerie actually just touched on them. The first is the fiscal channel. If we get fiscal out of the U.S., then that prolongs the U.S. exceptionalism narrative and helps the dollar. But the real kicker is tariffs, because tariffs are not only inflationary, and especially so in the U.S., FX is also the offsetting mechanism for countries, or the escape valve, to mitigate the impact of tariffs. So in a worst-case tariff outcome, we think euro-dollar can fall as low as 102.
What if tariffs become a growth negative? Powell was alluding to that yesterday, talking about the idea that actually it's the retaliation you want to look at, not necessarily the imposition of US tariffs, but how everybody else responds.
Exactly, and I think in that scenario, it all becomes about the relativity. So is the US still outperforming other countries in that scenario? We think yes. Even if tariffs are growth negative, globally, there'll be more growth negative in China and the Eurozone, and therefore the dollar as a whole can benefit.
Alex, picking up on that, what response, what reaction function do you assume then when you're thinking about tariffs and countermeasures by other jurisdictions? Because we heard from Andrew Bailey yesterday advising or suggesting that we shouldn't meet tariffs with our own counter tariffs. Is that what do you assume?
I think there's a lot of uncertainty around the way in which countries will respond or even the measures that will be implemented. So for now, we're less focused on that and more focused on the implications for monetary policy of tariffs, and actually of both tariffs and fiscal. We think these will prove inflationary, and the risk here is that the Fed is forced to pause. Now, that's not our base case, but that's certainly the asymmetry here, and therefore there's some upside risk for the dollar.
How will the euro respond in a world where we see a sort of cross-Atlantic wind, if you like, of higher rates coming across, and the ECB may be limited in its ability to transmit the policy choices that it wants to? We were talking to a guest yesterday who said, look, rates are going to go higher in the States, and just at a time when Europe is trying to cut rates, this is going to be really difficult. What's the euro going to do in amidst all of that?
The ECB is very focused, we think, at the moment on growth. And tariffs create a downside risk to growth in the Eurozone. So for us, we think the ECB can cut at every meeting until they get to 2% in 25 basis point increments. And that, we think, is going to undermine the euro, especially so versus the dollar, but also, we think, versus some of the higher yielding currencies or high beta currencies, which have central banks that are proceeding more cautiously.
Alex, there's been calls here for 95, less than parity when it comes to euro-dollar. What gets us there?
We think at the moment it's very hard to make a case that we need to trade to 95. We think the first stop, once tariffs are fully discounted, will be 102. If we think about past times when we have been at 95, not only have you had a recession in the Eurozone, but you've had a negative current account and really peak US exceptionalism. I don't think we're quite at that point.
What about the pound? How does that apply?
So on the pound, we think the story is actually positive in that it's the high yielder in G10, and it'll remain the high yielder for some time. The Bank of England can cut, but they'll cut very cautiously at a quarterly pace until we get to 375 by the end of next year. In terms of positioning, one thing that we find interesting from our metrics is that longs in the pound have reduced. So the market was quite long sterling. Those have been partially unwound because of a strong dollar and because of the post-budget episode. We see room for those longs to come back.
Just on the pound, the cutting, do you think that the GDP figures we've had out this morning, does that change your expectations at all? I mean, is there room for more cutting, more aggressive cutting from the Bank of England?
We don't think so. We think what will be required for the Bank of England to cut more aggressively is a looser labour market, and specifically some of the services, wage inflation to start to soften. And we're not seeing signs of that yet, and our base case is that that's not coming anytime soon.
First quarter of the Labour government, not positive when it comes to the GDP story. Let's talk about what is happening in Japan. The yen has been on a tear, like I'm talking about downwards here. What kind of changes the narrative around the yen, and how do you think, we probably don't need to talk about policy, government policy here, but how does the BOJ react to this?
I guess the first thing I should say, guys, exactly as you point out, the yen has been weaker, and we think the yen's been weaker because of US rates.
Right.
Now, if US rates continue to rise, then so too will dollar yen. But I'd make a few qualifying points here. The first is that we're already seeing verbal pushback from authorities onshore in Japan against yen weakness. We think the Bank of Japan can hike in December. And this is a little bit circular, but especially so if the currency weakens further into the meeting. So,
is that a better tool than intervention?
We think rate hikes will be effective in effectively stemming the yen a little bit. Now, the other point is tariffs are probably less impactful on Japan than they are on the Eurozone or China. That's not to say it's not a growth hit. Of course, it's a growth hit on Japan too. But out of the menu of funders, if you will, yen, euro, Swiss, and CNH, the yen might actually do best.
But CNH, and I would even throw in the Aussie dollar into that, are also quite exposed to that tariff story. How exposed?
So you're exactly right. The Aussie dollar is also exposed. We think the bottom-up fundamentals, though, are quite attractive. So the way we think about high beta currencies in general is you want to be looking for currencies that have good FX valuations, that have central banks that are proceeding at a slow pace when it comes to rate cut, and an okay growth story. And in that respect, Aussie very much fits that description. Aussie still also is one of the most sensitive currency to global equities in G10. And so at the point at which the market is priced for tariffs, we think there'll be opportunities in the Australian dollar.
Opportunities in the Australian dollar. Any other opportunities we should be talking about and are not? Because the thing that has dominated so much has been the strength of the dollar. And I'm sure that's had unforeseen consequences all over FX land. Alex, what do you look to?
I think for now it is really all about the dollar. And at least until Trump is inaugurated, it's very difficult for the market to, quote-unquote, sell the fact. So we think for now the dollar will continue to strengthen, especially so versus low-yielding currencies that are most exposed to tariffs, like CNH, like C3, like Euro.
I want to circle back right to kind of where we started, which is the pound. Give us a forecast. You said that was the positive, that's the high yielder. How high?
So in terms of cable, I think the next move might actually be slightly lower in following euro dollar, but euro sterling we think can fall beneath 83 and sustain that decline.
All right. Alex Jekoff, head of G10 FX strategy for Europe at BNP Paribas Markets 360. I think we got to almost all 10 currencies in that conversation.
Tick, tick, tick,
yeah,
tick.
he fired through them. But I think it's fascinating that even in this entire conversation, even with the risk of tariffs, with the risk of interest rates, he's still saying that the pound is kind of that safe haven piece in currencies. Do we see it in the bond market? Do we see it in the equity market?
Yeah, I mean, maybe not quite so much risk of tariffs on services as there are on goods. Seems to be the thinking that some of the economists are giving us. Yes, small, open economy. There's bound to be risk, and we heard Andrew Bailey reflecting on those just yesterday.
But the biggest factor for the pound is rates are going to stay high. Like, it is going to be, relative to everybody else, certainly in Europe, it looks like rates are going to stay high. And the UK's economy is going to struggle with the inflation story in a way that others aren't.
Yeah, and really interesting to see how low the euro gets then. And if you're thinking here about euro dollar, you know, we had a conversation earlier this week with Rachel Evans, wasn't it, who was saying that there are some houses starting to talk about the euro goes to 95. Yeah. But I think that was in the detail of that. There was some...
That was a tail risk.
That was a tail risk, and it was very much if Europe doesn't respond, you know, so if you just sort of accept policies out of the United States as X, this is where we could get to. And we just don't know what those policies look like in time.
So everybody's talking about Trump tariffs.
Yeah.
We're not talking about European tariffs. We're not talking about Asian tariffs. We're not talking about the response. Yeah. That's what Powell was referencing last night. That's where the hit comes through.
So this week, I believe Emmanuel Macron and Mario Draghi made some pretty strong statements at, I want to say it was the college in Paris, or university in Paris, and they were really talking about this idea of what levers they can actually pull when it comes to 60%, 20%. And they kind of came up short, but they did have a very aggressive stance, probably the most strong wording, the strongest wording I think I've heard from either one of them in a while. But it speaks to this idea, again, that is maybe most of that growth, is it less coming against the dollar, but maybe more against the pound? And that's where Alex's point around euro sterling maybe matters more. But I feel like it comes back to a much longer debate on things like youth mobility schemes and fun stuff like that.
Okay.
Fun stuff.
Yeah, the fun stuff. We'll have to wait for the fun stuff. Tell us when the fun stuff starts. Coming up, we will talk about markets a little more this morning. After US markets surge, is there value in European small caps? We will speak to Christina Matti, head of European small and mid-cap equities at Amundi. US small caps seem to be getting all the love right now. What's left for Europe? This is Bloomberg. Welcome back, everybody. Friday morning. This is the opening trade. We have 30 minutes to go until we get that opening trade here for European stocks. The futures picture looks kind of negative here in Europe. We have European stock futures called lower. US futures also called lower. NASDAQ futures down 0.7%. E-minis down 0.5%. There does seem to be some negativity coming through from a number of stories. Is this all about the Fed? Is it about pricing out at the margin, expectations of rate cuts in December? We still think there will be one, according to the market, but not quite as sure as we were. And we've got bond markets, of course, in Europe opening up around now. We see a little bit of a drift higher in bond yields, but not by much. I mean, that seems to be something that is weighing on sentiment this morning, the expectation that we're a little less sure than we were about Fed cuts.
Let's also fold in what's happening with the EV space, what's happening with the car makers this morning. We saw that reaction in the States yesterday, plus also after hours we get RFK coming in the United States. He's going to be going into health, and you already have seen an impact in terms of some of the healthcare stocks and European ADRs trading in the States. So you've got names like Sanofi and GSK could be firmly in focus this morning on the downside.
Yeah, I think it's going to be interesting as well. But how much of it is, and I mean, I have AstraZeneca on my mind in terms of that read-through, but how much of it is actually, of AstraZeneca's business actually exposed to the United States? I'm kind of thinking back to COVID times. It feels like the AstraZeneca was more of a UK story, whereas maybe Pfizer was more of a US story.
And it's very much it's an oncology and cancer play as well, AstraZeneca, away from the vaccine story. But we
Sanofi isn't. Sanofi's a big vaccine maker, and GSK has also got a pretty big side to its business as well.
So at the start of European trade in 29 minutes, we will keep an eye on all of those automakers and those pharma companies on the back of some of the policy suggestions we have seen and some of the personnel appointments that we have seen being announced by the Trump team and being reported by other media. Let us talk about what that means for Europe. Is there value in European small caps now? The sector is trading at a discount relative to larger peers. Can rate cuts make any difference to the prospects for European small and mid-cap companies? Joining us now is Christina Matti, Head of European Small and Mid-Cap Equities at Amundi. And Christina, given your title, I'm sure you're going to tell me there's reasons to buy them. But talk us through where you see the catalysts coming from for European small and mid-cap stocks.
Hi, good morning. First of all, thanks for the question and the interest on the small and mid cap. Definitely, as you mentioned, the asset class is coming from a severe underperformance versus large cap, and we believe that there are in front of us a couple of catalysts that can support a catch-up of the asset class. On one side, some more top-down driven elements like the interest rate cycle that with the recent and the start of cuts both in Europe and in US should be in favor of the asset class, and considering with that the idea of a more controlled inflation path, and as well a slow but improving economic cycle. The asset class is very much geared toward the economic cycle, so all these elements should be at support of an investment in small and mid cap. On the other side, I would... Sorry.
Yes, I was going to say how important are interest rate cuts to that narrative, Christina? Because, of course, yes, we are expecting that the ECB keeps cutting, but can the ECB keep cutting at the pace we anticipate if the Fed stalls, if the Fed pauses in its cutting?
Well, historically, there is an inverse correlation between the asset class and interest rates. So while interest rates are rising, obviously the asset class is mainly in the past were perceived very much penalized by higher cost of money. And so this is why an inversion of interest rates should be now read more in favor of the asset class per se. I want to stress that it's even true that recently the fundamentals and balance sheet of the small and mid cap in Europe has improved a lot from 2008, so from the great financial crisis. A lot of companies have put a lot of attention to their leverage, so even this element of link to interest rate should be a bit more mitigated than in the past.
Christina, good morning. It's Guy. Post the election in the United States, US small caps have done really well and European small caps have done really badly. Why is that trade wrong? You just laid out a whole load of reasons, but are you saying that trade over the last few weeks is the wrong trade to put on?
Well, so the US election has been I would say a catalyst for all the equity markets. It was bringing volatility, and it was bringing uncertainty. So now with this this element clear out, I think that there should be more traction, first from the US small cap, that, as you know, are more domestic oriented. Normally, even small cap, wherever they are more domestically oriented than globally exposed. And so the Trump ideas and policies in protecting the US economy should be in favor of US as well. In Europe, we are coming a bit later, so now this uncertainty is over, but we think that the current situation of small cap in Europe is very much compelling, considering the underperformance and the cheap valuation they are trading, with fundamentals that remain very solid. EPS growth, it's still forecast to be higher than large cap. Putting all these elements together, this should be translating a catch-up of this gap of performance between the asset classes.
Yeah. Christina, I hear you, and I hear that your case is built around valuations. It's certainly one we're exploring in other parts of the world as well. But I'm curious about the recession risk here, specifically because small caps have a asymmetric exposure to recession risk, and when it is priced in, if there is a onset of a tariff war between the United States and Europe, if the ECB or even the German elections or even the French budget stories don't come to fruition, small caps have far more exposure to that recessionary risk. How do you price that in? How do you hedge it in the small cap and mid cap world?
That's a fair comment, of course, and I believe that in case of a recession or a severe recession, all the equity markets, with no distinguish, will suffer. So it's something, and it's a risk that we have to keep in mind and to factor in. There has been, even in our internal forecast, moved from a possible technical recession in the US more to a slow economic growth, so a bit improvements of the landscape and less probability of a recession. But in that case, if that will materialize, that's true that this is a risky element for all the equity markets and for small cap, of course, as well.
All right, Christina Matti, head of European small and mid-cap equities over at Amundi, walking us through that potential bull case for the equity story. And it feels like in small caps, in the mid-cap market, maybe M&A, maybe that deal activity may be on the agenda as well. JPMorgan CEO Jamie Dimon says that companies will be more aggressive in pursuing acquisitions after the Trump victory. He spoke to Bloomberg at the APEC CEO Summit about how regulations have previously stifled deal activity. Take a listen.
Because they have the Senate, the House, and the presidency, they have far more ability to do things like that. I think last time around, President Trump had started by saying for every new regulation, 1 in, 2 out. And I think later on he said 1 in, 5 out. I think they're going to do some of that again. I think it will, the banking industry, whether you voted for Trump or Joe Biden, a lot of bankers, they're like dancing in the street because, they've had successive years and years of regulations, a lot of which stymied credit. And so and you could have kept the banks equally safe, but had them do more credit. And so, to just give you an example, the average bank in America, I think the number used to have $100 of deposits and $100 of loans, and now it's $100 of deposits and $65 of loans. And if that's what you want, if for some reason the regulators think they're geniuses and that's the best way to run the banking system, so be it. But I think they did a lot of things that ended in that answer, but they didn't know that was going to be the outcome. So, and I think you could talk to any industry, and they'll give you examples of regulations that could be reduced and make it easier for them to do business while keeping the country safe, while keeping the air clean, while making sure the EPA does its job, et cetera. So I applaud them. They should be looking at those things.
Do you think if there is, particularly in the banking sector, less regulation, that there will be an even steeper competition with banks getting back some of the business from private investment firms?
Probably, yeah. I mean, because if you look at, you're asking about private credit and private investment, which I'm not against, and it has grown very rapidly, and it's got pros and cons. I'm always in favor of competition, but part of the reason that they are dancing in the street, which they said publicly, they used to get mad at me, now they say, no, he's right, is half the capital. No social requirements, no AML, no BSA, no fiduciary, no reporting to the government, no insurance, no liquidity, Yeah, it's a huge disadvantage. So, yeah, I think it'll make banks get back some of that business. I think it'll be more important to regional banks than to JPMorgan.
There's also a question whether it's banking mergers and acquisitions or just more broadly, whether there's going to be a more amenable administration to tie-ups. Are you seeing from your conversations in the past 7 days with companies that they are looking to expand their M&A pipeline to start putting that together?
Yeah, so absolutely. I mean, a lot of M&A was stymied by the fact it's not just sometimes you can't get through the courts or something like that, but it takes 2 years. It takes 3 years. So make believe you're a bank, and we've seen this happen, and one of these deals actually took 3 years. It takes 3 years to get it done. So you've done a deal, it's binding, you haven't closed it, but now you've got to run the company. You can't get the synergies, you're going to be losing people. You want to start working a common culture and common technology, you can't do it. So yeah, a lot of companies are looking at, will be looking much more aggressive at acquisitions and deployment of capital, and they should.
JPMorgan CEO Jamie Dimon there speaking with our very own Lisa Abramowitz at the APEC CEO Summit. I think it's fascinating. He's saying that the deal activity is going to be picking up because of the Trump victory. We heard that from Jane Fraser over at Citigroup as well. And I think it's fascinating here that he's saying that they're not now encouraged to deploy the cash that they've been sitting on. Haven't we been having this conversation with these mega cap tech companies, these S&P 500, arguably stock 600 companies as well, that have been sitting on piles and piles of cash but haven't been able to deploy it? And it's been feeding buybacks here in Europe. It's been feeding some M&A activity in the U.S., but it's mostly showing up in things like dividends.
Are these guys getting ahead of themselves? I listen to J.D. Vance, and I hear what he has to say about deals getting done, particularly in the technology space. He's more from the consumer side of things. Is he actually stepping away? Is his view a significant departure from what Lina Khan and people like that are doing in terms of restricting some of this M&A? Like, how big a voice is he going to have? We don't know yet what's going to happen in terms of the regulators around this space. Are the bankers getting a little overexcited?
It seems you've got a lot of people in the mix with quite different ideologies.
Yes.
Is this going to be ideologically driven? Is it going to be more case by case? Is it going to be what plays best for the social media audience on that particular day? It does remain quite unpredictable, but in the meantime, the bankers seem to be filling in the blanks and saying this is good for M&A. I mean, it was looking that way anyway, wasn't it? From things we were hearing from Dimon and Barclays and others, that they were seeing some of that M&A coming back, but they see it really coming back under Trump.
Yeah, it's fascinating as well. And you mentioned the FTC there. Lina Khan, the FT reporting that the FTC may be launching an investigation into Microsoft as well. They're really trying to push these last couple of bids through while they still can. For this point that you made, I think it's also crucial that this is where the EU really has a little bit more maybe mobility. Meta in the last 24 hours having this massive fine out of the European Commission. I'm curious, in this environment of deal activity, maybe this is Europe's chance to step up to the plate if regulation is what they're shooting for.
Do you fade the banks rally now, though? Because it's been extraordinary. You look at the KBW and the numbers. There is hot money out there chasing this banks rally.
But if it's based on strength in the US economy, then maybe it has further to run, or, or maybe not. Maybe tariffs get in the way.
Maybe tariffs get in the way. Maybe the assumption that actually M&A is going to be easier ultimately gets in the way.
But the trade-off here from that kind of hit that they were going to get on net interest income off kind of rate cuts, for example, now suddenly made up by the capital markets, except maybe the cuts are being priced out. So this is almost a win-win scenario for the banks.
The rate story is interesting on that one.
Yeah, it's going to be a fascinating one. Also in focus, of course, as we talk about what this new administration may actually look like, are U.S. pharma stocks. They dropped in the last 24 hours as Donald Trump picked RFK Jr. as the next health secretary. We're going to take a look at their European rivals as well. In terms of that direct read-through, that's all part of your stocks to watch next. This is Bloomberg.
With labor market conditions in rough balance and inflation expectations well anchored, I expect inflation to continue to come down toward our 2% objective, albeit on a sometimes bumpy path. We're confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks to both sides. The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve.
Fed Chair Jerome Powell, of course, speaking just yesterday. Let's talk about the markets in 3 minutes with Markets Live Executive Editor Mark Cudmore. And Mark, let's get your thoughts starting there. Let's start with those Powell comments. No hurry to cut rates. What does that mean, do you think, to markets for December and for 2025?
I think it's putting a bit of doubt that the 25 basis points cut will be delivered in December, which was almost fully expected before those comments, and that's why it had a bit of a reaction. I think this is kind of reasonable. Inflation has clearly shown that it's a little bit sticky, and obviously they're worried about the inflationary policies that might be from the incoming administration. And then now we've got to wonder about what's happening in the jobs market. There's been signs of weakness, but I have to say, initial claims yesterday, again lower, which, I really think puts a lot of pressure on the jobs print before the next Fed meeting. That will probably really decide whether we get that 25 basis points or not. Overall, though, I am still in the camp that the Fed will struggle to cut as much as is still priced, even though we've rode back in some of those bets. It'll still struggle to cut as much as priced unless there's a sudden crisis in the economy.
So is the bond market at the moment underpricing that risk? How quickly could we accelerate to the upside on yields?
Look, it really depends what gets delivered in the policies in the administration. There's a lot being talked about. I think there's a real risk, given that some of the things be considered, that yields could go a lot higher next year. But I think it's right for bond markets to not rush to that conclusion. So, no, they're not underpricing it right now. I think actually one of the conclusions might be that bond markets might bounce around in a range at the moment until we get more clarity what might be delivered, because there is so much uncertainty, and really it could be quite binary in either direction next year. I don't think the long end base for yields is as low as some people were hoping. We're not going back to the pre-pandemic era. I think we've got more normalized markets. So I think that that the tail risks are on both sides, but I think they're much bigger for higher yields. But really at the moment there's not much certainty. We probably have to wait to the new year to get really exciting movement in the bond market again.
Mark, 444 on the U.S. 10-year this morning. How high does it go? What's the ceiling?
Again, it depends on what policy is delivered. I think the idea that we talk about 5% at some binary level is ridiculous. I can very easily see a world under some of the policies that we discussed where 10-year yields go much higher next year. I don't think that 5% is some stopping point. But I also see a world where they go back below 4%. So I really kind of think that 10-year yields are going to be stuck in this kind of range for a while until we get more clarity what's going to come through from the new administration. What does that range look like? I don't know. On the spot, making it up here, I'm saying roughly kind of 420, 470, 430, 470, that kind of thing, that range. I think there's going to be really big move in bonds next year, but I think trying to preempt it before we have clarity on policies doesn't make much sense. And I think there'll be a little bit more excitement in the front end because we do have that uncertainty whether there will be the cut in December and what comes after that. So I think actually more of the excitement will come in the front end until next year, and then next year it'll all be about the long end trade.
All right, Bloomberg Market Live Executive Editor Mark Cudmore joining us this morning with his calls. You get more up-to-date analysis from him and the team. MLIV Go is your terminal function on Bloomberg Terminal. Let's go for the macro to the micro. Joe Easton standing by with our stocks to watch. Joe.
Morning, Kriti. So we're watching vaccine stocks in Europe today after Trump picked RFK for his new health secretary, a known vaccine skeptic, and wrote on Twitter that the industry has been subject to disinformation, according to Trump, writing on X with Robert F. Kennedy, his pick for health secretary. Now, we did see a drop in a couple of ADRs in the US yesterday, including Sanofi, which is known for its respiratory vaccines, listed over in France, and also GlaxoSmithKline, which is known for its shingles vaccines. Both of those did see pretty steep drops in late trading yesterday, so we are keeping an eye on those drug makers this morning. Then staying in pharma, we've also got a bit of M&A in the mid-cap space. Evotec over in Germany getting a takeover bid from a US-listed rival. Now, this stock has done really well over the past month because we've seen private equity buying a stake in this, and there has been reports of potentially a full takeover coming in. But we can see over a long term that this valuation has slumped quite a lot as the company has downgraded its earnings guidance, including as recently as August, where they issued a massive profit warning. So that's potentially making this stock more attractive and therefore getting that bid coming over from the US today. Then over in insurance, we got Generali, the massive Italian insurer, around €40 billion market cap, and they are reporting strength once again in their life business. Now, this is what we have seen driving that stock higher. We can see it up 40% over the past year. It is the third best insurance stocks in Europe over the past year, given strength in life. But as such, we do see quite a lot of hold ratings on this stock, potentially people sitting on the sidelines and thinking perhaps this is priced in. But in terms of the numbers themselves, they do look pretty strong for Generali today. Then over in analyst ratings, we've got Barclays changing its preference on hotels. Now they upgrade Intercontinental Hotel. Holiday Inn is their big brand, whereas Premier Inn is downgraded to equal weight at Barclays. And finally, in shipping, DSV in Denmark, that one is an outperform over at Exane this morning.
Joe, thank you. Equities reporter Joe Easton on this Friday morning with some of those stocks that could be on the move. The bigger picture here is that we could see some negativity in European trade and US futures deteriorating a little bit the closer we get to the start of the trading day, thinking maybe about the Fed and just how likely that December rate cut is.
Yeah, it looks like we're going to be down circa 0.5% maybe across the board. Some markets doing a little bit worse. Yesterday was a strong session, though. You need to see it in light of that.
Tech was pretty strong. Bit of asset sale going on in that world.
Yeah, Europe was strong. US actually maybe faded a little bit. So the European session maybe needs to price some of that out today. But I'm fascinated to see how the car sector opens today. I'm fascinated to see how the drug sector opens today. The impacts of the States continues to be felt over here in Europe.
And one eye on the commodity sector as well. I think yesterday we saw a little bit of a divergence between the oil names and the more mining names of China versus maybe Middle East read-through as well. This morning you are seeing Brent crude on the cusp of $70 a barrel. Does that show up in some of those commodity names? We'll keep an eye on that. Futures in the red. Stick with us. This is Bloomberg. We are minutes away from the opening trade across Europe. This is really important. The selling is accelerating into that open. You can see it in the futures picture, down by 0.8% for Eurostoxx 50 futures. It's a combination of different factors. Some of that's going to be some of the selling we saw over in the States. The FTSE 100 down as well, down about 0.4%. Some of that might be a little bit of the oil market. This is going to be crucial as well in the context of where that pain comes from. Is it the pharma stocks? Is it the EV stocks? DAX futures going to be interesting as well, down about 0.6% in the futures trading. Anna, I wonder how much of that's going to be a read-through from some of the sectors we saw over in the States as well. Again, red across the screen, red across every region.
Yeah, absolutely. Let's just put a few of those sectors that we are watching on a screen for everybody, just to sort of home in on them. But pharma stocks will certainly be in focus then, Chrissy. At the appointment of RFK, Robert F. Kennedy Jr., a known vaccine skeptic, of course, raises the prospect of a tough path ahead for some of these pharma companies. So we will certainly keep an eye on those. Moderna, Pfizer, Novavax all down in the US session. How does that read across into European stocks? On the automakers side as well, we've had this really interesting report from other media suggesting that perhaps some of the subsidies for EV sales are going to disappear in the United States. What will that mean for some of the automakers? Yes, stateside we saw those react, but also here in Europe we'll keep an eye on those and that complicated story there. Generali in the insurance space, we had an update from them. The numbers there, Guy, coming in better than expected for net profit, operating profit, recent natural disasters being quantified by Generali, so we have a little more to trade on this morning. But big picture, we're also thinking about the Fed and the prospects of a rate cut for December.
Being priced out, that is the critical thing. And you look at what Europe has got to do today. So Europe session yesterday, pretty decent. US session fading. You need to price that in. That's why indexes look like they're going to be lower this morning. Then you've got those key sectors that we've just been flagging as well. Let's take a look at the European Open. Expected to be soft. It already is. The FTSE's down in negative territory. You're going to see a lot more red across the screen as we start to populate some of these fields on the screen in front of you. And I'm expecting you will see the pharma sector certainly being an area of focus. The auto sector is going to be interesting. What about the banks? What happens with this rate story? What is going to be the impact there? Stock 600 down by 0.3%. FTSE 100 down by 0.3%. Let's call it that, 0.4%. So we're giving back some ground. So this growth narrative that maybe the Reeves Treasury wants to see here in the UK, certainly not showing up in the markets this morning. I think you can probably separate the two. But the CAC 40 down by 0.7%. It is a significant loser. Let's look below the hood and see whether our early predictions in terms of the sector story are proving prescient. Kriti, what are we seeing?
Well, as expected, Guy, we are, of course, seeing those tech stocks and the biotech stocks, the pharma stocks as well, all taking a hit right alongside commodities as well. I'll give you some early movers to the downside. Novo Nordisk, AstraZeneca, Sanofi, GSK. In terms of index contribution or index weights to the stock 600, that's where your pain lies. A little bit of a bright spot, though, in utilities here. You are seeing that sector higher by about 0.1%, Anna, but broadly red across the board.
Yeah, absolutely. It's a very red. It's a very red experience looking at the stock 600 this morning. And we are selling those sectors that we flagged earlier. So healthcare, as you say, Kriti, is under pressure. Auto is also under pressure, and these are very much linked to news flow coming out of the United States, to either appointments or other reports around regulation or subsidies. So that's really fascinating to see. But also technology is a bad performer today, the worst performer, in fact, across European equity markets, and that may be just a reflection of how far it travelled north yesterday, but that was the best performing sector today. We see some of those chip names under pressure today, ST Micro, ASML, for example. What is interesting is you are getting a bounce back in some of the renewable sectors.
Yeah.
So
Vestas is coming back, Ørsted's coming back this morning. Some of the defence stocks are also a little bit higher as well. Not enough to obviously offset the losses that we're seeing in names like ASML, Novo Nordisk, some real heavyweights that are moving on the downside. It is the big vaccine makers that are certainly suffering, but it's broad-based. Like the pharma sector is down broadly on the back of this. Novo, Sanofi, Roche, AstraZeneca, Novartis in terms of the points drop that we are seeing. So it's not just the vaccine makers, it's the pharma sector that is under pressure here as well. But some of the winners recently, Schneider's having a less good day. But Anna made the points earlier. Generali, the biggest points gainer here in Europe this morning.
And I should say, buried in all that, ASML as well, adding to the points.
The biggest points. Well. That's the biggest points loser.
Yeah, exactly. So not such a great picture for Europe. So the question is, where do you actually buy, and how much of Europe is taking the lead from really what's happening over in the States? Morgan Stanley Chief U.S. Equity Strategist Mike Wilson spoke to us about his year-end target for the S&P. Take a listen.
We could probably trade 6,100 probably before year end, so we're right there. Could we get higher than that in the near term? I think it's going to be hard, but yeah, we're marching higher. Finally, after 2 years, we're finally starting to see a broadening out in the broader economy, and that translates into better stock performance for the average stocks.
Joining us now, Chris Watling, CEO and Chief Market Strategist over at Longview Economics. Joining us around the table this morning. Good morning.
Good morning.
Let's talk a little bit about this divergence between Europe and the United States. Buy the U.S., sell Europe seems to be the trade in vogue. How long does that last?
I don't think it lasts too long. I mean, I think there's sort of a bit of post-election surge on the back of the Trump clean sweep, which is clearly a very pro-growth agenda, with the one caveat on tariffs, of course, which is an important caveat. And I think that Europe's taking a bit of a hit on that. But I think, as to what we just heard on the clip, the market participation should broaden. I feel cyclically the global economy should be re-accelerating quite nicely into next year, and that will change the way stock market sectors behave and where the leadership is. So the leadership, as we know, up until the middle of this year was very much narrow Mag 7 and so on. But I think, and that's of course because most of the West was stagnating for a couple of years. But I think as we deliver this cyclical impetus, as we cut rates, as we get more fiscal stimulus, cyclical global economy in the West is going to re-accelerate, and global stock market participation is going to broaden away from the Mag 7. In fact, the market's already trying to think about that. Other than absent, these overnight sort of news flow, healthcare, pharma, which I think is fascinating. I think there's more to it than just vaccines, by the way. It's much more complex than that, the appointment of Bobby Kennedy. But, yeah, I think the market's broadening, and cyclically the global economy looks really good for next year.
The idea, though, of this Mag 7, this concentration risk of this breadth, some would argue will kind of already have that dynamic that exists in the stock 600. Guy loves to look at the core 6, the sensational 6, or even the granolas, you name it. This idea here that the breadth, the concentration risk isn't a risk in Europe. Could that be a bull case to invest here?
Well, there's undoubtedly, the sort of granolas in Europe were caught up with the Mag 7 idea. There was definitely a move to the large cap stocks around the world, the mega caps, over the last year or two, sure, almost as a defensive play. But look, mid caps, small caps, pick your country. S&P 400, S&P 600, UK FTSE 250. Domestic plays on Western cyclical recoveries are very attractive. They're cheap areas of the market. And there are parts of the large cap sector that haven't been caught up in this trade in the last couple of years that are interesting.
So I want to go down the cap scale.
Go down the cap scale. Yeah, just get...
That's a valuation argument, right?
Yeah, it is essentially a valuation argument. And it's not a valuation argument, it's a broadening argument that happens. What's done well is expensive.
So what's done well is expensive?
Yes.
How expensive?
Absurdly expensive in many ways, absolutely. I always say valuation is never a good market timing tool, as we were discussing beforehand, and you can prove that in a million ways. But it is expensive, and the cheap stuff, you know, put it this way, we've got this sort of thing called the hidden gems. There's 4 country stock markets around the world that are less than 50% the valuation of the US that had faster earnings growth over the last 3 or 4 years. Well, a couple of them a bit obscure. So Hungary and Poland, and Greece is vaguely obscure, and then Italy. All of these countries are growing earnings faster than the States.
Right.
And, you know, no one's in them. No one's owned them forever. But they're doing very well. Italy's doing very well. Greece is doing well. I like Spain. I think it's a really interesting country. You know, these are places no one's talked about for 15 years. And they are back.
Great. Do you watch the show? I
Sorry, apologies. You and me. It's just you and me.
There you go. United
against the world.
United in
and the Spanish,
the Iberian Peninsula. What about Trump's tariffs? Sorry to rain on the European parade, but what about Trump's tariffs and where that? I mean, that might be for Northern Europe much more of an issue, or not?
Well, firstly, we think there's a switch of growth leadership in Europe from the north to the south.
Yes.
And agreed, Northern Europe's more of a trading powerhouse. But, yeah, I think Trump's tariff is the big risk in all of this. And of course, we, the market, none of us really know whether it's day one, bang, the whole lot, or day one, we'll do a bit on China, we're going to negotiate. No one knows. The market doesn't know. And to be honest, the currency's already moved a lot. You know, that was the one thing that looked certain over the course of October. Trump was going to win the presidency. We didn't think he'd get a clean sweep. And the market priced in the tariffs risk. That's why the dollar rallied. So I think a lot of it's in the price. It's not good. It's disruptive. But, you know, I don't think it's enough to throw this whole thing off.
We're going to end up in a. Are we going to end up in a sort of tariffs arms race? Do you think? Is that the assumption? Do you assume that if Trump puts on tariffs, that other countries respond? Because we heard from Andrew Bailey overnight urging countries not to respond in that way. But politically, is that going to fly? You know, we've already talked about Harley Davidsons and Levi jeans when it comes to Europe getting its own back on the US.
Chris's 2 favourite things.
Chris's weekend. I just described Chris's weekend.
None of the above, actually. I know, I must look like that. No, I think the Europeans are a bit. There'll be some tit for tat, but I think it'll be measured.
So that,
you know, it's not like no one's dealt with Trump before.
Really, for the valuations and for
it does matter. It is important. It's not helpful. It's not a good thing. But actually, most studies show most of the effect falls on America, not on Europe. So, you know, there's a lot to think about. I mean, there's a lot going on. China, of course, is a huge issue. Germany's a huge issue. They're both big global traders. But, you know, China's stimulating. They're going to keep going. So I just think the stimulation probably overwhelms everything else.
But
we will see.
Is there a complacency to that? I mean, it just feels like when you look at this market reaction, they do stimulate, and they do try to get that, and it lasts for about 2 minutes, and then it goes right back down. I'm just wondering how much tolerance is there for that? Is stimulative policy still stimulative?
Yeah, I think it is, absolutely. It's just a question of degree, and it's a question of what you're doing and where you're doing it. I thought what Rachel Reeves said last night was the first decent thing I've heard her say, that we're going to de-risk regulation.
Okay.
Fantastic. Get regulators to go for growth. You know, the problem with Britain is we over-regulate and we discourage risk-taking. You know, it's not complicated, is it? We live in markets. You take risks, you get a return. It's the same in the economy. You take risks, you get a return. If you sanitise everything, you don't get returns. So that's good. And Trump is going to deregulate the banking system. Great. That's good for risk. All of this stuff. Shrinking government. Please, let's have it here. You know, great that they're going to do that in America.
So UK pension funds should buy fewer gilts and buy more stocks?
They certainly should, yeah. But we need to loosen up the whole stock market. We need to get more capital friendly, basically, in this country.
You don't hear 2007, 2008 calling, wanting a repeat of a crisis.
We are miles away from 2007. That's over concern. We've gone so far the other way. At least let's go back to the middle.
In terms of, up until now, big index has done relatively well. So let's come back to this valuation argument. Big index has done very well. A lot of people's pension funds, etc., have done, therefore, very well on the back of the argument that the S&P just keeps going higher. How easy is it going to be to get people's pension funds, get the average sort of savings account higher in a world where it becomes more dispersed, that you're looking at things like the FTSE 250. At the moment, all you've got to do is put your money in the S&P. It keeps going higher. Valuations get really high. Mega cap tech continues to do really well. Is it going to be harder to do that in a world where you have a more diversified market?
Well, it shouldn't be harder because there's more stocks to choose from. But
not all of them are going to go up, well, whereas the concentration risk has allowed you simply just to go, I'm going to own the Mag 7, it's going to go higher.
Well, this is how markets work, isn't it? It's the emotion. People get crowded and hold on to one idea and they find it very hard to leave it. But the reality is the good guys go first and eventually everyone follows. You know, you look at the Mag 7 already since July. Nasdaq's been stalling out. It's got no momentum. It's a Mag 1 or 2 now. I mean, Microsoft's sort of faffing around its 200-day moving average. And that stock 3 months ago, everyone loved.
Yep.
And they would never dare sell it. And I bet you they're starting to think about it. So it takes time. It takes time. The clever money moves first.
You heard it here first. Chris Watling, CEO and Chief Market Strategist at Longview Economics. Thank you very much indeed. Talking of cores, let's take a look at what happens with the Core 6 this morning here in Europe. This is the picture that we see ourselves with. Certainly some selling going on across Europe. Novo is down by 2.21%. The pharma sector is under significant pressure. Luxury is also soft today. Look at Ferrari. Maybe that's getting caught up in the car story as to what is happening. Though Ferrari and electrics is a relatively new phenomenon. ASML is softer. Schneider is down by 0.8%. Even the safety trade, Nestle, you could argue, the staples down by 0.7%. What else are we watching this morning? Joe Easton has all the details.
So we are seeing some weakness, Guy, particularly in these vaccine stocks today. As Chris was explaining just a few moments ago, it's not just about the vaccines, though. It is a broader decline in health, as that Novo move was suggesting as well. But the weakness clearly in the big vaccine stocks. Sanofi in Paris down 4%. Glaxo here in London almost down 4% as well. Bello, now this is specifically just vaccines, so there's a good read on what's going on in this sector. And Bavarian Nordic, that is the big Mpox vaccine maker. But bear in mind, they have had their own numbers out this morning as well. But I think part of that 15% drop on that one to do with RFK's appointment to the health department in the US. Then staying in pharma, we have got this deal for Evotec. It's around $1.5 billion market cap in terms of where it closed yesterday, so it is a lot smaller, but it's up 20% as we get a takeover bid from the US. Evotec say that they are looking at the deal. They haven't actually agreed to it yet, but they are keeping an eye on that one at the moment. Then in insurance, Generali extending its gain. It was already up 40% this year. It's up another 5%, almost. Strength in the life business, and the property and casualty losses not as bad as expected. They were quite expected to be quite high given the catastrophes we've seen in the US, also Canada as well. Aegon more in the pension business, that one looking okay over in Amsterdam, gaining around 2% at the moment as well. Then we will flip over and look at Landsec. It is the office owner around the City of London, a lot of city properties. The numbers looking pretty weak, mainly some declines in some of their valuations, but a lot of that, again, it's priced in over the past couple of years, and it is looking to rebound at the moment, up 1.5% for Landsec. Then in rating changes, Burberry, a 20% gain yesterday, the most on record as it rebounded following their numbers, still down sharply, of course, but we have got UBS, a long-term seller, saying that they think the strategy is showing signs of a turnaround. They no longer recommend selling Burberry. They come up to neutral today. Pretty decent move on that one. Then over in renewables, you guys have been discussing, we're seeing renewables higher today. Some traders telling me it's just a bit of an unwind from some of the Trump losses that we've seen, but also Ørsted has a rating change over at DNB. It comes up to hold. So that one is gaining over in Copenhagen, up 1.6% in renewables today.
Joe, thank you. Joe Easton with that rundown, that briefing for you on some of the stocks that are on the move, and a couple of them coming from those really interesting sectors that were on the move over in the United States. We will focus in on the auto sector next. Coming up, EV stocks dropped over in the United States after we saw reports in other media that the Trump administration is considering letting go of some of the subsidies, that boost sales in that space. We'll get to that next. This is Bloomberg.
18 minutes into the Friday session. Welcome back. You're watching the opening trade. This is what equity markets look like. As you've probably guessed, we're a little lower this morning. As you can see, down by, let's call it 0.6% if we average maybe all of those numbers. That is the picture that we are seeing here in Europe. You're seeing the car sector under less pressure than the pharma sector this morning. Those are the two sector stories that stand out from the US session yesterday. We've got this idea that subsidies are going away in the car sector, in the EV space, and that RFK is going in to run healthcare in the United States. The pharma sector under pressure as a result of that. Tesla and Rivian shares certainly under pressure in the US. This after a Reuters report that suggested that President-elect Donald Trump is considering dropping a consumer electric vehicle tax credit, part of the IRA. Bloomberg's global automotive editor Craig Trudell joins us now to discuss. What do we actually know? All of this just what do we know, basically, is the question.
We know that he can't just sort of, do this with the wave of a hand.
This is Trump.
This is Trump. That these tax credits would need to be taken away, through an act of Congress. And we have seen some indications that there are some members of Congress actually that would be quite concerned about doing away with these tax credits, because there's been a ton of investment in EV and battery manufacturing, and that includes in a lot of red states. And those factories that either are being built or are just spooling up would really be undermined by sort of pulling the rug out from those EVs coming to market. I do think also that the other questions here is also other elements of the IRA that may potentially be vulnerable, including manufacturing tax credits. That those too would be detrimental to those projects.
So this no doubt gets complicated in the minds of many Republicans when they look across their state and the actual facts on the ground as to what's supporting growth. And it gets complicated. Does it get complicated in the mind of Elon Musk as well? Because we saw Tesla hit by this. You assume Elon Musk is in the room when they're talking about these things. He said he doesn't like subsidies, but this one seems to benefit one of his big businesses.
It absolutely does. And I think there has been, sort of some lazy analysis that this will, somehow be good for Tesla. And I just don't buy it. I mean, they are the biggest EV maker in the U.S. They have the most consumers that have been benefiting from this tax credit, far and away more than any other manufacturer. You can't sort of, on one hand, as Tesla has repeatedly for years now, emphasize affordability and the need to bring their prices down, and then somehow, make this argument that actually, we don't need this $7,500 to make it easier for consumers to consider our cars. This will hurt them, and I think there is this sort of cold calculation on Musk's part, and you've heard him articulate this on earnings calls, that yes, it'll hurt us somewhat, but maybe it will be even worse for our competitors. And that springs from they are actually making money making and selling EVs. Their competitors aren't, and so he's sort of making this calculation that we won't be hit as hard. That there is some flaws, though, to that.
Or just good for self-driving cars, Kriti, and good for giving him some leverage to try and push for that. I mean,
Yes, a terrifying prospect as well. Very quickly, Craig, I want to ask a little bit about, does this incentivize then Tesla and Elon Musk to then expose to other parts of the world, ramp up the European consumer base, the Chinese consumer base, very quickly?
I mean, I think this is a case of they make their vehicles in the U.S. for the U.S. generally. So I don't think that this necessarily leads to Tesla sort of changing up, how they compete in other parts of the world. This turns the U.S. into a market with less growth potential for them in the next year or two.
Certainly something we're keeping an eye on. Bloomberg's Craig Trudell, we thank you so much. Another sector, of course, in focus is going to be European pharma stocks, also under pressure this morning after President-elect Donald Trump picked RFK Jr. to lead the U.S. Department of Health and Human Services. Joining us is Bloomberg Intelligence senior pharma analyst Sam Fazeli. Sam, what do you make of this drop? Is this actually a valid reaction, or is this simply just trading in sympathy, given so many of these pharma stocks maybe have a limited exposure to the U.S. from a vaccine perspective?
Yeah, so look, I think we've been considering the possibility that RFK Jr. could be in this position. This is not totally news, but the fact that it actually happened is making people worried. If you look at the vaccine, particularly the ones that are purely vaccines, like Moderna, BioNTech, especially Moderna, you would have seen that the stock has been declining for various reasons. One of them has been this. So the discussion here is, of course, now President-elect Trump has said that he's going to be nominating him for HHS, which is the key body in the United States as regards health policy, etc. If, and that's a big if Senate confirms RFK Jr., then of course we're in a world where
where
something has changed.
We'll come back to that thought. It's interesting to see just how the share prices are reacting, though. It's not just the vaccine makers that are under pressure here. There seems to be a broader kind of commentary that actually this is going to impact healthcare stocks across the board, and it's going to have multiple impacts. You look at what happens with pricing, you look at what happens with the way that drugs are distributed. There's all kinds of aspects of this story that could change really quite significantly. HHS, this is a huge institution, though.
Yeah, I was really interested in the wording of the announcement from the incoming Trump administration, elected administration. They put pharma products in a list with other things that they think are a threat to the health of Americans. Pharma products as a threat to the health of Americans. So they talk about pollutants, pesticides, food additives and pharmaceutical products. And I know that that's been, there's been a lot said about medications for depression and the like. And you can see where that thinking comes from. But this is incredible to see those words in the same sentence.
Where does it leave Ozempic? Where does it, like all these other products that potentially are going to have a massive impact into the United States? Does that change going forward? Sam Fazeli is back to answer that where question. Sam, does this go beyond vaccines?
Apologies for my feed being sabotaged by the look of it. Maybe I was saying too many things that people don't like. But the reality is, if you look at this, and I think we talked about this the other day, Guy, there is this sense of anti-science attitude. Because the things that some people are saying, vaccines have been the one thing that have saved humanity, genuinely. Antibiotics, fluoride in water. I mean, I don't know where the science is coming from. There is no science that they're looking at. Therefore, what it tells me is that if this happens, we're going to get somebody in charge who doesn't actually follow true science, but follows what they believe is feeds their views of how health is being impacted by pharmaceuticals, etc. So it's going to be a very difficult period when we are anti-science.
Sam, thank you very much. Sam Fazeli of Bloomberg Intelligence. A lot to watch, and we'll watch those Senate hearings, of course, and confirmation hearings very closely, assuming that they happen. Coming up on the programme, we'll get back to the European growth story. The UK specifically, the economy growing slower than expected in the last quarter. We got those numbers out for the month of September. They looked a little bit sluggish. We'll discuss the outlook for the UK. That conversation coming up next. We heard a lot from Mansion House, of course, from Rachel Reeves and from Andrew Bailey at the Bank of England. We'll get to that conversation shortly. This is Bloomberg. This is the opening trade, 30 minutes into Friday's session. It is a negative session for European stocks. We're down 0.8% on the Stoxx 600. And actually, US stocks, futures worsening just in the last half hour or so. NASDAQ futures now down by over 1%. So a sense of perhaps some of the individual sectors in focus. We've talked a lot about pharma and autos this morning, but also this sense that maybe we are starting to price out, we haven't done yet, but starting to price out a Fed rate cut in December. That's certainly hanging over market thinking this morning as we head into Friday. Now, the UK economy cooled more than expected in the third quarter after a surprise contraction in September as anxiety built over the new government's fiscal plans. It comes as the UK Chancellor Rachel Reeves used her Mansion House speech to suggest it's time to loosen some regulation brought in after the financial crisis.
It was right that successive governments made regulatory changes after the global financial crisis to ensure that regulation kept pace with the global economy of the time. But it is important that we learn the lessons of the past. These changes have resulted in a system which sought to eliminate risk-taking. That has gone too far. And in places, it has had unintended consequences that we must now address.
Let's bring in Anna Andrade from Bloomberg Economics with thoughts on the UK growth story. And so, good morning, Anna. So we hear from the Chancellor. She's sent strongly worded letters of instruction to city regulators, the FCA, PRA, FPC, all of these acronyms have received these letters to say, you know, you've got to put growth front and centre. Is that going to be making the difference, knowing what you know about the growth story up to this point in the UK? What's needed, Anna?
Hi, good morning. So I would definitely say that what Rachel Reeves is trying to do is a step in the right direction, but answering to your question on whether it will make a difference, it's very, very unclear at this point, and I wouldn't say so right now. And I mean, there's two reasons for this. One, what she's trying to do is essentially to consolidate, to do a major consolidation in the pension industry to sort of unlock more investment. But there's a question around whether that investment would flow to the UK in the first place. I mean, investment will flow to sort of places that are attractive, and right now the UK economy, the growth story around the UK economy isn't very attractive. We had GDP data coming out this week, today. It was a little weaker than we had expected, and honestly, the sort of medium-term outlook for the UK economy is also not great. We're expecting modest gains of around 0.3%, and there's not going to be sort of a turnaround in growth anytime soon. So until that happens, businesses might not be sort of convinced that it's in the UK economy that they need to invest.
Anna, of course, it's going to be top of mind for the thinking over at the BOE, but there was kind of a footnote in some of the way that the BOE might be restructuring some of their bond portfolios, one that could free up about £10 billion for the Treasury. Can you walk us through that change, the repercussions for, one, the Treasury, but then also the BOE?
Well, I think now the fiscal space that Rachel Reeves led herself in the last budget was very marginal. I think what we need now is sort of an economy that grows more, that generates more revenue. I think that's sort of, we're talking a lot about how we can get a little bit more money from this change or that change. But in the longer term, the only way that Rachel Reeves is going to get enough money to grow out of its debt problem is by growing the economy faster. And the steps it took in investment will help. The investment that she announced in the past budget will lift output by around 1.4% in the long term, but more is needed. And I think that's also, just going back to the Mansion House speeches that we heard yesterday, I think that's also why Andrew Bailey, the BOE government, opted to talk about Brexit. It's because we're right now in an economy where it's really, really hard to sort of do any single policy that it's a major game changer for growth. And Brexit actually is one of the simple economies that, although it's obviously very politically difficult, it can deliver a big boost to the economy in the long term. And it could help, obviously, Rachel Reeves with her public finances situation.
Anna, great stuff. Thank you very much indeed for the update. Anna Andrade joining us from Bloomberg Economics. Let's talk about another aspect that came out of the Mansion House speech last night, delivered by Rachel Reeves, the Chancellor. The UK is going to introduce legislation next year, legislation to pull 1.3 trillion of local government pension savings into a series of mega funds. Basically, there's a minimum requirement now that is going to be produced in terms of the size of these funds. So you're going to see consolidation and potential efficiencies coming out of this. The new Labour government is trying basically to deliver on a plan to boost private investment and economic growth. But will this achieve this? What impact will this have? Let's get an idea of this. We're joined now by former UK Pensions Minister and current member of the House of Lords, Ros Altmann. Good morning. Thank you for your time this morning to discuss this. Let's start off with the idea of consolidation and efficiency. Legislation is going to be coming through. Is this to be welcomed?
Well, in theory, of course it is to be welcomed. We have to see, with pensions, there's always the devil in the detail. And in theory, I think the government's idea is that if you've got bigger pools of money, you get economies of scale in the cost of managing them, but also more money can be diversified across more different projects and more different investment opportunities, which should give higher returns, but with a broader spread of risk. That's the theory. In practice, it's going to take an awfully long time, I suspect, to merge these funds. And the government really wants to get growth going quickly. It's not clear at the moment what urgency there's going to be in terms of achieving this, and administratively, it's not simple. And just merging funds doesn't guarantee you more investment in the UK or better returns either. So we have to wait and see what is planned.
Better returns and more investment in the UK. Is that the same thing?
Well, it could be, certainly in the shorter term, because one of the reasons the UK has languished and performed so poorly in the last number of years is because pension funds, which are a massive pool of domestic investment that in the past always used to have a significant proportion in UK markets, has been selling down the UK or not flowing into and been diversifying outside the UK, which became a bit of a self-fulfilling prophecy. So if you get more money from our pension schemes returning to the UK, that should help with a re-rating and bring more investment alongside it too.
The UK pension funds, particularly DBS schemes, defined benefit schemes, already invest heavily in the UK. They do so via the gilt markets. Now, you do wonder whether or not this is something of a zero-sum game. If the government were to mandate, which some have suggested, that UK funds should invest in the UK, let's call it up to 25%, which is the current tax benefit that they gain, is there a danger that actually they sell out of the gilt market in order to facilitate that and in the process hit government financing in a fairly significant way? We've already got a big seller in the UK gilt market in the form of the Bank of England.
Exactly.
If UK pension funds, DBS schemes, start selling, how big a risk would that be to the UK's public finances?
Well, it's a lot more complicated than that, actually. And indeed, the 25% could be of new contributions rather than of existing assets, because I think that would be a more intelligent and manageable way of assuring that money goes into the UK without too much selling. Now, on the defined benefit schemes, I think it has been wrong anyway for them to have so much in the gilt market. Unfortunately, when QE was going on and the Bank of England itself was buying gilts, you had this ludicrous situation of UK pension funds competing with the Bank of England to buy gilts at ever higher prices. That was all somewhat reversed in 2022 with the kind of crash in the gilt market. But as pension schemes head to buyout, they want employers want to get rid of the risk. Those schemes that have already decided they're closed and the employer has no further interest, they are buying gilts because the insurance companies want to take over their assets in much lower risk, supposedly lower volatility investments. Once the insurance companies get hold of the defined benefit assets, the first thing they do is sell the gilts. So you've already got that risk. And I think what's much better is for us to get growth going in the economy, help drive down the fiscal deficit, because you've got private investors and pension funds doing the heavy lifting to try and boost growth in infrastructure and so on. And that itself will relieve some of the pressure on the interest rates in the gilt market. That could be a virtuous circle. And we could use, and I believe we should use, our pension schemes money much more intelligently, and especially with open defined benefit schemes and new money flowing into pensions. We should, I think, mandate at least 25% must go into UK productive assets.
OK, and Baroness Altmann, I know others would argue that that might not be in the best interests of pensioners. I mean, there may be pensioners who do better if their money were all able to go to the US to invest in AI, or to China, or to India, or to wherever the hot market of the moment is. What answer do you give in that situation to those pensioners?
Number one, I would say if you want the tax relief, you have to, as a quid pro quo, invest 25% of new money into the UK. If you don't want the tax relief and you think other markets around the world will do even better than you would with the help of tax relief, Nobody's stopping you. And you would still have 75% of money available to invest wherever you like. And I believe that the arguments which say you shouldn't invest in the UK because it's underperformed in the past miss the point that part of the reason it's underperformed in the past, a large part in my view, is that domestic investment has collapsed from our own pension schemes. And in other countries, Australia, Canada, which the Chancellor has used as an example, a huge proportion of their pension assets are in their own domestic market, unlike ours, where you've got well under 5%. In many other countries, the US, Australia, Canada, Japan, Europe as well, they have 20, 30% or more in their own domestic markets. We have 3 or 4%. So it's clear there's an opportunity here.
I think some may question whether Canada has that significant home bias that you're suggesting, but certainly true that other countries with large pension funds maybe do have that home bias. Former UK Pensions Minister Ros Altmann, thank you very much indeed. Don't know I did that. Coming up, the US President-elect Donald Trump selects RFK Jr. to become his health secretary. More on that and Trump's other cabinet picks. We'll talk about that next. This is Bloomberg.
We would expect is very clearly that, first of all, the government is back in full force so that they can address the geopolitical, the economic challenges which we are all facing.
We have huge challenges on the labor cost side, on the energy cost side. Bureaucracy costs are too high, and our corporate income taxes are not competitive.
We would like not to exit Germany, but to the contrary, attract capital into Germany. And on that front, I have to agree the 15% cap in the DAX is not very helpful.
Yes, we have to invest, but at the same time, we have to look where you can save money, because that's not for free.
What we need now is, as soon as possible, so the faster, the better, a stable political situation with defining a clear target picture for the economy that is missing.
German business leaders there speaking to Bloomberg over the past month against a backdrop of economic gloom and certainly increasing political turmoil over in Germany. Let's widen the conversation to think about where the EU economy goes. The European Union Commission publishes its autumn economic forecast today, 9:30 a.m. at UK time. So in around 45 minutes time, we'll get the details of where they see things going. Bloomberg's Oliver Crook will be looking for the details there, and he joins us now from Brussels. Ollie, you are what, forecasting a forecast here? Is that what we're doing? What are you looking for in these projections?
Yeah, exactly right, Anna. So listen, these are going to be the sort of the forecast for GDP and CPI, the sort of things that will be watched very closely here among everybody in Europe for next year, but also the first forecast into 2026. And we don't have the numbers yet. We're going to get them very shortly. But if you look at the sort of Bloomberg aggregate for what to expect for GDP and CPI, for this year, we expect growth at 0.7%, less than a percentage point of growth across the Eurozone. Next year, that ticks up to 1.2%. And then into 26, coming up to 1.4%. A couple of points to make about that sort of these sorts of growth figures. These are very, very muted figures of growth even for Europe, right? There were some very good years after the pandemic that were sort of brought back by a lot of the stimulus, but these are even below trend what we got going into the pandemic. So this is much lower, and this is really coming into relief because the Europeans now are realizing that they're going to be competing intensively against China, against the United States, and really need to find ways to boost growth. There is a silver lining, however. It is not, unfortunately, on the growth front. It is on the inflation side, where you see that we still have inflation in Europe of about 2.4% this year. They're expecting it to drop down to 2% next year and into 2026. But of course, there are a ton of risks on the horizon. We'll be looking through these sort of forecasts to also see kind of where the growth is concentrated in terms of sectors, but also geographically across Europe.
Ollie, I'll give you two quotes. Everybody has a plan until they get punched in the mouth. That's relevant for this weekend coming up. And it's difficult to make predictions, especially about the future. Talk about these predictions going forward, these estimates as to what Europe is going to be looking like going forward. Could it be about to be punched in the mouth by the Donald Trump presidency? Therefore, does everything fall apart in terms of what happens next and the response that comes through? How difficult is it to make predictions in a world where we don't know what impact this Trump presidency is going to have? We're putting together a cabinet that could produce some quite out-there outcomes.
Absolutely, Guy. And I mean, I think the differences between Europe and Mike Tyson is perhaps a little bit less prepared to be punched in the face. And that's kind of the issue before the European Commission. And the issue that you're talking about, Guy, is there's a huge shadow that looms over these numbers and over the European continent. And it's in the shape of Donald Trump. We do not know what we're going to get from the Trump presidency yet. We do not know what we're going to get in terms of tariffs. If we get 10% tariffs, as he has talked about on the campaign trail, that costs the European economy, according to Goldman Sachs, 150 billion euros every single year. That is the difference when you look at the sort of forecast that we were just talking about between some growth in Europe and zero growth in Europe, right? There's also the question of China. How does China play into this? Is there going to be growth in China? Could that help the Europeans? But also, if Donald Trump slaps 60% tariffs onto the Chinese economy, all of that overcapacity then flows into Europe. That might help on inflation, but that is flying directly in the face of what the European Commission wants to do with this new sort of commission and its sort of Draghi report, which is to become more competitive and to be more sort of self-reliant. These are all the issues that they're tackling. And then, of course, now European leaders are beginning. I'm saying beginning because over the last week, everybody has been very reticent to say anything negative about Trump or to even consider that he may be sort of slapping tariffs on. We had Emmanuel Macron speaking earlier this week saying that we are very clearly entering a world of tariff wars. So the question now for the Europeans is they need to start to get out of reaction mode into proactive mode and to start to discuss what these sort of Europe first policies might be able to look like. And that is going to be sort of what is going to be in focus going into this new commission, which will start in December. The issue you guys have is, of course, the question of fiscal. There's a huge amount of debt in Europe, so really not in a strong position to get punched in the face.
Bloomberg's Oliver Crook there walking us through some of the economic forecasts and sentiments over in Brussels. We thank you so much. You don't want to miss Oliver's interview with Paolo Gentiloni, the EU Economy Commissioner, excuse me, I can't speak today, at 10:45 a.m. UK time. A fascinating conversation, of course, is some of those budgets are still yet to be submitted to the EU. That conversation, 10:45 a.m. UK. But let's kind of zero in on what Ollie was talking about, is what's happening over in the States, especially with Donald Trump and some of his cabinet. They are taking shape as the president-elect selects vaccine skeptic RFK Jr. to become his Health and Human Services Secretary. For more on those cabinet picks and the week we've had, Bloomberg's senior writer, Stephanie Baker, joins us around this table. All right, so for our international audience, I think we should preface the RFK conversation by saying he comes from a massive American political dynasty, one that has kind of shunned him from their own politics. They had endorsed Biden and then Harris. And, of course, RFK Jr. has taken a very different approach after having run for president himself. What policy changes could come with him in this role?
Right. I mean, the reason why this is so surprising is he wasn't asking for it. The expectation is that he would have take a health czar role in the White House that wouldn't require confirmation. So this did come as a surprise. Obviously, he's a noted vaccine skeptic. He's come out against fluoride in water, traditionally a local issue in the United States. But he's also talked about food policy, and I think that's an area where he could get more consensus and support. He famously attacked Fruit Loops in the United States for having too many additives, but he got his facts wrong, saying that, other countries didn't have that. But, he's right on a lot of those issues. So that's a place where he could get more support. That's notable that to be confirmed, he needs to go through 2 Senate committees. Not only the Senate Health Committee, but the Senate Finance Committee, because Health and Human Services oversees Medicare and Medicaid.
Yeah, and tell us a bit about how that process works, because you expect a Senate hearing, and yes, the GOP controls the Senate, but it doesn't take that many senators to rebel for you to get some of these appointments denied, but that assumes you get a hearing. So tell us about the process.
Right. So Republicans still have a relatively slim majority in the Senate. So all it takes is a handful of Republicans to break ranks and dissent on any of these nominations. So, whether or not they will have the courage to come out and defy Trump after he led them to this sweeping victory remains to be seen. Trump has obviously talked about wanting to do a lot of these appointments under recess. appointments that would require the Senate and the House to vote by a majority to adjourn the Senate to allow him to appoint these figures for as long as 18 months. And, I think there'll still be opposition. It's not going to be so easy to do recess appointments.
So there's a lot of questions here in Europe about what all these policy changes, given so much of this is inward looking. There were plenty of very controversial picks this week. Tulsi Gabbard, of course, being one of them as Director of National Intelligence. Plenty Russia-Ukraine conflict talks when it comes to the Defense Secretary, the CIA Director, among many, many other positions. What stands out to you in terms of the most game-changing for European policy?
Well, obviously, Tulsi Gabbard is a shock pick for leading all the U.S. intelligence agencies. She has met with Syrian leader Assad. She has, parroted various Russian talking points, and the idea that she'd be overseeing U.S. intelligence is a shocker, and I think she will face opposition if she comes up for confirmation hearings. Pete Hegseth as Defense Secretary is another shock pick. He served in a relatively junior position in the military. It was a Fox News anchor.
Yeah.
He's notable for his tattoos. He has the Jerusalem Cross, which is a symbol of white nationalism. Now, he said that these are just Christian symbols, but that is a very controversial appointment beyond the fact that he just has no management experience and is sort of patently unqualified to lead one of the largest armies in the world.
Stephanie, great stuff. Thank you very much indeed, Stephanie Baker, on what is happening in the formation of the Trump cabinet. Let's talk about what is coming up next. What is coming up next? We've got Friday to get through, but the weekend is almost upon us. Christmas markets are going to be kicking off this weekend, I think, up in Warwickshire. The German ones kick off next weekend. The ski season, I think, starts next weekend.
It's too early for Christmas markets. Can I
the
just make that really boring point?
In the car on the way in the morning, the music has definitely started on the radio stations.
Yes, and
Christmas
they sell
music.
Christmas food from August, which doesn't mean you have to buy it.
The lights are everywhere. I'm eating it up. In the States, we still be in Thanksgiving mode right now, so I
You've got to get through that, don't you?
I know.
Yeah. Sport, big weekend of sport.
Yeah.
So England's going to go aerial at Twickenham this weekend, I think, to try and beat the Box. I think that's going to be pretty hard. They're looking quite good at the moment. I have to say, my kids are quite excited about Jake Paul versus Mike Tyson. Everybody has a plan until they get punched in the mouth. Jake Paul.
And you took this to the world of tariffs earlier, which was exceptional, I thought. Very nice little metaphor going on there. But yeah, we'll focus on the boxing perhaps. Because of the boxing, but maybe because of it being all live on Netflix, which is something of a it's not a first, is it? But it's a big deal when
they're getting into
live
more
events.
live things.
Absolutely.
And streaming apparently makes money, according to Disney.
Going onto the streamers. Right, speaking of the weekend, be sure to catch up with Bloomberg's new weekend edition. Plenty of essays, reviews, interviews and stories for you. This is Bloomberg.